More regional banks are failing. We recently covered the massive failures of multiple regional banks that led to a global banking crisis. It seems we haven't seen the end of the destruction. Now, PacWest, Western Alliance, and other regional institutions are showing signs of panic-inducing weakness. Today, we'll look under the hood to figure out exactly what's causing these bank defaults and uncover the safest places to hold your money. As we previously detailed, the global banking industry has been hammered by the closure of Silicon Valley Bank and Signature Bank in March, as the Fed was forced to intervene, using extreme measures to stabilize markets. Meanwhile, Switzerland's Credit Suisse, a critical important bank to the global economy, had to be rescued by rival UBS. While some blame the banking crisis on loose monetary policy, followed by strict reversal and expeditious interest rate hikes by the U.S. Federal Reserve over the past year, others believe that what we're seeing now is more of a management issue that is affecting specific institutions. SVP was absolutely a case of poor management. To understand the management decisions that led to these collapses, think of how retail banks typically operate. You deposit your money into a bank, and in return, you are promised that you will have access to your funds seemingly whenever you want to access them. Truly, only a small portion of your deposits at a bank are actually held as cash. Concurrently, banks use the rest of your money to invest into vehicles such as consumer or business loans, government bonds, and credit cards. Additionally, banks borrow and lend money. A traditional view of the banking system would lead us to believe that the lending capacity of a bank is limited by the magnitude of its customers' deposits. In order to lend out more, a bank would have to secure new deposits by attracting more customers. Without deposits, there would be no loans. Well, in our modern economy, the capacity of bank lending is not entirely restricted by banks' ability to attract new deposits. In fact, banks are now able to create deposits. Instead of just holding consumers' money, banks are able to create deposits by extending credit, meaning creating new loans. When a bank makes a loan, there are two corresponding entries that are made on its balance sheet, one under assets and one listed under liabilities. The loan counts as an asset to the bank, and it is simultaneously offset by a newly created deposit, which is a liability of the bank. And since banks are able to lend more than the actual number of deposits on hand, they tend to lend first and look for reserves later. Banks can borrow money on a short-term basis and lend that money either short-term or long-term. For example, they can borrow money with a 6-month duration, then they can extend a 30-year mortgage to a consumer. Their risk is short-term, but the consumer's risk is long. Many banks tend to match up their liabilities, meaning that the mortgage, a long-term loan, is matched up with long-term borrowing. If a bank borrows a bunch of short-term money while they also have longer-term obligations, there can be a mix-up of matching assets with liabilities. When interest rates rise, as has been the case in our economy for quite some time, the value of existing bonds decreases. This can offset the bank's balance sheet on its own. To exacerbate the problem, consumers are now able to withdraw their funds from banks at a rapid rate thanks to the advances of technology. To cover these withdrawals, the bank will have to sell bonds at a loss. Such was the case with Silicon Valley Bank. This example highlights the concept of duration risk. SVB was overexposed to duration risk, and consequently, the bank was unable to hold its bond to maturity. When it was just SVB, it was easy to blame management. Now, however, we see a pattern that extends beyond management. One industry that is extremely important when we consider the state of banking is commercial real estate. Many banks own billions of dollars worth of commercial real estate debt. These are mortgages on large office buildings or other commercial properties. And since millions of Americans are still working remotely, at least part-time, many of these big buildings in metros like New York, Chicago, and Washington, D.C. are empty or partially empty for much of the week. As a result, companies are cutting the amount of space they need. Owners of these buildings are increasingly seeing tenants, and therefore their monthly lease payments, shrink or even disappear, all while they may still owe a ton of money on those buildings. This can lead to defaults on that debt, and it already has in some cases. Defaults on commercial real estate loans recently surged to their 14-year high, and there have been numerous high-profile defaults in DC and Los Angeles. It's easy to surmise that there may be many more commercial defaults in the months that lie ahead. Some regional banks that have a lot of commercial real estate debt exposure are PNC Bank at $42 billion, Citizen Financial with over $30 billion, Valley National at approximately $29.4 billion, and KeyBank, which has exposure of about $22.8 billion. These are just a few of the top regional banks with high commercial real estate debt exposure, and there may be others with equal or higher amounts of exposure. All of the noise surrounding banking seems to lend more credibility to big banks over smaller regional ones. First Republic Bank, for example, was acquired by banking giant JP Morgan after First Republic became insolvent. The auction process by which JP Morgan was able to acquire First Republic emphasized the idea that big banks are getting stronger while it's getting harder for smaller banks to do business. Some believe that the First Republic Bank auction outcome showed unfair competition and a dangerous increase in too-big-to-fail banks, all while harming community banks, small business lending, and economic growth. JP Morgan already holds more than 10% of the nation's total bank deposits. JPM's net deposits are believed to increase by 3% as a result of the deal. JP Morgan Chase CEO Jamie Dimon believes that large, successful banks are necessary in the world's largest economy. He argues that the ability to serve cities, schools, hospitals, governments, and the World Bank as clients is extremely important to the status of the United States. When it comes to regional banks, everyone from market analysts to President Biden are calling for stronger bank regulation and supervision. Meanwhile, the biggest banks are holding up quite well. Many believe that big banks are the safest place for their money, and also much safer to invest in than some of their smaller counterparts. What are your thoughts? How confident are you in regional banks or traditional banking in general? Let us know in the comments. As always, thanks for watching, and we'll see you in the next video.